Have you ever just stared at a stock chart and felt like you could almost see a story playing out? You know, a peak here, a valley there. It looks like it's trying to tell you something, like a kind of secret language. But is that language actually real, or are we just, seeing shapes in the clouds? Well, today we're going to try and find out. For centuries, traders, sometimes called chartists, have absolutely sworn by these patterns. They give them all sorts of names, like head and shoulders or range breaks, and they truly believe these shapes can predict where the market is going next. But the big question is, can we prove it? Can we scientifically show that these patterns exist and that people are actually trading on them? And right away, this question sets up a classic showdown. On one side, you've got the academics. Their big idea is the efficient market hypothesis, which basically says the market is a random walk. What happened yesterday has zero bearing on what's going to happen tomorrow. But on the other side, you have generations of traders saying, hold on, markets are made of people, and people, with all their fear and greed, create these repeating, predictable patterns. So, to try and settle this debate once and for all, a team of researchers kicked off this massive investigation. They dug into over a decade of high-frequency data from some of the biggest, most liquid markets in the world. Their mission was to get past all the opinions and find some cold, hard statistical evidence. Okay, so the first hurdle they faced, well, it's a huge one. How in the world do you program a computer to see something that even humans have a hard time agreeing on? It's kind of part art, part science. Just look at the difference here. On the left, that's what a real price chart looks like. It's jagged, it's messy, it's full of noise. And on the right, that's the clean, simple head and shoulders pattern from a textbook that traders are trying to find in all that chaos. Our brains are actually pretty amazing at filtering out the junk to see that underlying shape, but how do you teach a machine to do that? The first attempts didn't go so well. A lot of the traditional methods, like trying to smooth the data out with moving averages, they just couldn't hack it. They'd either smooth away the important peaks and valleys, or they'd get totally fooled by all the little meaningless jitters in the price. The real challenge was figuring out how to find what actually matters. And this is where the researchers got really clever. They borrowed an idea from a completely different field, geography. It's this concept called topographic prominence. So think about a mountain. What makes it a significant mountain? It's not just about how high it is. It's about how far you have to go down into a valley before you can start climbing up an even taller mountain. It's just a brilliant way to measure what truly stands out. And just look at what this does. By applying this idea of prominence, the algorithm could finally ignore all the little bumps and wiggles and just identify the significant peaks and troughs. It transformed that messy, noisy chart into this clean, linearized series of points. All of a sudden, the computer could see the market the same way an experienced trader does. Pretty cool, right? Okay, so mission accomplished on part one. The computer can now spot the patterns. But, that's only half the battle. The next mystery, which is arguably even harder, is this. When one of these patterns shows up, is there a hidden surge of trading that's directly tied to it? A signal that's buried deep under all the normal everyday market noise? To solve this, they needed a tool that could act like a kind of statistical detective, something that could track a faint signal that you can't even see directly. So they turned to this incredibly powerful technique called particle filtering. Let's break this down because it's pretty wild. Imagine you're looking for the true intensity of this pattern-based trading, but it's invisible. First, you just watch what the market is actually doing. That's your evidence. Then you unleash thousands of little digital particles. Each one is just a guess, a random hypothesis about where that hidden signal might be. Then, as new market data comes in, you check every single guess. The ones that made good predictions, they get rewarded, they get stronger, they even multiply. And the bad guesses, they just fade away. So what happens is, over time, this huge cloud of scattered guesses starts to come together. The best ones survive, and they start to zero in on the true hidden signal. It's this amazing way to find a needle in a haystack when the needle is completely invisible. So the team had their tools ready, they had a way to see the patterns, and they had a way to detect the trading activity they might be causing. They pointed this whole machine at years and years of market data. The big question is, what did they find? And here it is, the big reveal. For two of the most classic old-school patterns, the head and shoulders and range breaks, the statistical detective found a strong, absolutely undeniable signal of trading activity, especially in futures markets. But for others, like strategies based on moving averages or trend lines, the evidence was way weaker, almost inconclusive. It turns out some patterns really do seem to matter a whole lot more than others. And these charts show you exactly what that signal looks like. See, for the range breaks and head and shoulders, you get this clear, distinct bump of higher trading intensity. It's obvious. For the others, the signal is just flatter, weaker, almost lost in the background noise. The data was crystal clear. Something real was definitely happening when these specific patterns took shape. But hold on, the investigation wasn't over, because the most fascinating piece of this whole puzzle, the real twist in the story, came when the researchers asked a really simple question. When is this pattern-based trading most active? So just think about that for a second. When would you guess traders lean on these simple visual rules the most? Would it be when things are calm, orderly, lots of buyers and sellers around? Or would it be when the market is totally stressed out, chaotic, and it feels like nobody is trading? Well, the answer was completely counterintuitive. The data showed that the intensity of this technical trading actually spikes during times of low liquidity and high stress. So when the market is under the most pressure, that's when traders seem to rely on these simple patterns more, not less. This quote from the research paper just nails it. It really suggests that when good information is hard to find and uncertainty is through the roof, our brains fall back on these simple visual shortcuts. The patterns become a kind of anchor in a storm of chaos. So, after all that, what's the big takeaway? What does this whole scientific detective story really tell us about the markets? Let's bring it all together. The evidence is pretty compelling. These chart patterns, they aren't some kind of magic crystal ball. They're more like a visible footprint left behind by our collective human psychology. They're a self-fulfilling prophecy, really, driven by the traders who believe in them, especially when they're stressed and just looking for a simple rule to follow. And that leaves us with one last really fascinating thought to chew on. We started this journey with a machine trying to learn to see like a human. But now, as algorithms get better and better at detecting and maybe even getting ahead of these very human psychological footprints, you really have to wonder, in the market of the future, who is really influencing whom?